Hi, and welcome to this week's look back at the major news stories that have affected the market so far. And now, of course, we're into March and hopefully a bit of spring in the UK. So we're going to take a quick look at what's happened between January and February so far this year. And I think it's pretty safe to say that February has removed January's positive news. So January, we saw some positive sentiment in the markets, mainly due to the peak of inflation seemed to have passed. That's what a lot of commentators were saying. And the fact that China lifted their COVID restrictions, opening up one of the biggest markets in the world. However, February has seen that mood change due to new data that's showing inflation has remained stable and that the recession forecasts are back on the agenda. Let's look at a few numbers. So the S&P 500, for example, in January was up 4.9%. In February, down 2.7%. Gold up 6.2% in January, down 5.2% in February. The euro up 1.6%. for January, down 2.7% in February. And sterling, obviously these are against the dollar, up 2.1% in January, but February saw that fall by 2.2%. So obviously February we saw an increase in strength of the US dollar, and the yen was no different. By March the 1st, it was at its lowest level since the start of this year. And in fact, we're seeing it looking at approaching 138, which has been both support and resistance previously. So what happens in the start of spring, the start of March? Will we see a continuation of February's negativity? Well, we've got some figures coming out which it's important to pay attention to. March the 14th, we'll see inflation data out the States, and March the 22nd, we'll see the Fed meeting. And of course, we are expecting a 0.25% increase in interest rates, but obviously a lot of chatter in the markets about exactly what's going to happen. So February, not a great month. Let's hope March brings us some more positivity. Okay, for our second video, we're going to stay sort of on topic a little bit from the first video and have a look at some of the action in the last week of February. And that's the fact that the US indices posted their worst week of the year so far. The S&P 500 was down 2.7%. In fact, that's pretty much the number it was down for the whole month. And its worst performing week since December the 9th, 2022. Now, one reason that's being bandied about is the PC, or personal consumption index figures that came out in the States. Now, the Fed pays particular attention to these in terms of the inflation rate, etc., and the fact that it rose above expectation, which pretty much adds weight to the argument that the inflation battle goes on. In fact, Charles Schwab's chief strategist is reported as saying that inflation can't and won't come down without a wider economic downturn. And obviously that's referenced now back to recessions, hard landings, soft landings that we've spoken about before. David Rosenberg, who's a very well-respected analyst on Wall Street for more than 30 years, published in the Business Insider an article that the recession will sweep the US economy within the next few months. So again, this talk about recession really coming back to the forefront. If we have a look at the chart, it shows that the S&P index futures have fallen to the lower line, that's number one, of the ascending channel. We did sort of expect that based on what had been happening, but it's clearly marked there. The question is, will that turn into support? Well, obviously a lot of people would hope so, but a bearish breakdown is definitely possible if those analysts we've spoken about already and other counterparts are correct in their assumptions and their projections that the US is in fact going to hit a recession. Okay, so we've highlighted the States, or the United States, so far, but let's have a look at what effects that's having across the pond here in the UK. And let's have a look at sterling and the fact that there is a GBPUSD bearish pattern. Now, March the 23rd, we're going to get the Bank of England's latest rate decision. Now, pretty much everybody expects that to go up 25 basis points. And as the UK seems to be having the toughest battle when it comes to inflation and GDP, thus potential recessions, Andrew Bailey, the governor of the Bank of England, said this week that further rises may not be inevitable, nor should we say that interest rates have peaked. Now, this is a little bit confusing for a lot of market participants and clearly spooked a few. This is a different sort of tune that we've heard to previously. As a result, cable, or Great British Pound against the US dollar, has traded lower as a result. It's continuing to form a bearish pattern on the chart. You know, we see a double top pattern based on the highs of December and January. And at the same time as that, the so-called neckline runs in a psychological level of 1.20 GBPUSD. Now, February, clearly the market lost its upward momentum. That's framed by the blue channel that you can see. And the quote's in fact fixed below that bottom line just recently. So 1.19 may well fix a bearish breakdown, and we may well see some further declines. And as we're currently sitting at the high 1.19, we're looking at 1.198 at the moment. It's a market to keep your eyes on, but it's also a market to use your risk management techniques, because it is quite possible over the coming weeks to see a bit of extra volatility. Okay, for our final video, we're going to depart the more traditional markets and have a look at some cryptocurrencies and the fact that the SEC is putting more pressure, or certainly seems to be, on the crypto market. Now, Robinhood, a very popular US broker, listed itself, works on a sort of zero fee, low commission basis, received a notice from the SEC about them opening a case re the listing and storage of cryptocurrencies by their clients. Not great news, obviously. On top of this, Coinbase, due to regulator pressure, is going to suspend its operations with BUSD, that's a stable coin from Binance, on March the 13th. Thirdly, there was an article published in Forbes magazine that said the actions of Binance Exchange, obviously one of the biggest players out there, with its funds, resemble what FTX did just before its collapse. Now, that has been rebutted by the head of Binance, who said that customer funds are secured on a one-to-one basis and there'd be no problem with withdrawals. But obviously this is news that's coming out, is piling more and more pressure on the crypto industry. Let's have a look at the chart, Bitcoin against the USD, and it shows signs of bearish activity amid this pessimistic backdrop. We saw sellers defend the psychological level of $25,000. That's point number one on the chart. And now they're looking to take control of 23.8 thousand level. Now that's point two, which has previously been an area of support. If this sort of mood continues and this sort of negative press and continuing pressure from the SEC continues, could we see us hitting the Feb lows of around 22,000? Now, it is worth noting that crypto markets, not available to all clients of FXOpen, in certain jurisdictions you need to be classed as a professional client due to regulations, is notoriously volatile. The fact we had a little bit of lack of volatility for some time last year, it seems to be returning. So, particularly when it comes to something like crypto, risk management is going to be key. Now, we wish you luck with your trading and the week ahead, and we'll see you again soon.